Okay guys, this is a short video concerning an introduction in finance. So I used the Prezi and it reads now, let's start with two questions. Question number one, I have great idea but no money. What should I do? So this is, let's say, an interesting question in finance. You have great ideas, you're young, but you have no money. What should you do? Ponder on this question. The other question is, I have some spare money. I put it under my bed for worse times to come. Is this smart? Or should you do something else? So you're somewhat older, you earn some money, you have some money to spare. What should you do? Ponder on these questions. Because these are, basic questions within finance. Because if we look at our structure, this is the structure of finance or corporate finance, and what do we see? We see there are entities with a supply of money, they have a surplus, and there are people with shortages of money. And the whole idea about finance is, how do we get the surplus? How do we transmit or transfer this surplus to the shortage? So, how does this work? Now, you could say that can be via direct finance or via indirect finance. And we will discuss later what these terms mean. But this is basically your whole structure for finance. All the things we're going to do, valuation of bonds, stocks, credit default swaps, whatever, these are just money transfers and transfers of risk, but we will come to that later. But more in a sense this is the basic structure. All things in finance you can probably place in this scheme. So let us go on. Who are the players in the field? Who are the entities with a surplus of money? Now, by the way, if you have a surplus of money and you want to get it to the people with a shortage of money, we usually call this investing. So this is why these things start here. Private persons, it can be you, it can be your grandfather, it can be Bill Gates. Private persons who have money to spare are investors and should transfer their surplus to the people with a shortage. It can be banks. Banks collect a lot of money and they should transfer this. Big companies like Google, maybe they have a lot of profits. What should they do with it? And those institutional investors like pension funds, they collect a lot of money to pay out when you're 65 or whatever the age may be in your country when you retire. And what should they do with it? They can put it under their bed, they can put it in an old sock, but what is a smart thing to do? The other institutional player are insurance companies like, for instance, ING, the Dutch insurer, but also AIG, which is now very famous since the crisis. So these are, the players within the scheme that have a lot of money. They have money to spare. And they should transfer it to the entities with a shortage. Who are the entities with a shortage? Again, these can be big companies. For instance, Shell want to exploit, an oil field in Nigeria. They need money for this. So they go to the bank or they go public. They issue bonds or whatever. Banks nowadays, if they have financial problems, they can have a shortage. Small companies, for instance, bakkerij means bakery. It's just Dutch for bakery. It can be small companies that need money, for instance, a mortgage or a loan, whatever. Private persons, again, a guy maybe who has great ideas but no money. It should be a shame that those great ideas go to waste. So what happens? He should be supplied with money with the people who have it. And of course, the largest lender in the world are the governments. So if you want to have social plans or whatever, you want to construct a new highway, You can raise taxes, but taxes don't get you elected, so you usually issue government debt, usually in the form of bonds. Yes? So the government is also usually in want of money, so they have a shortage. Okay, so how do we transfer this money from the surplus to the shortage? This can be in an indirect way, and we call this indirect finance. And indirect finance is nothing but finance via intermediaries. And usually they are banks, but they can also be other financial institutions. But let's keep it with banks. And how does this work? For instance, via debt or a loan. And this is what we see, a loan to the government. A very old one. And this one I wanted to show you. These are very small microcredit loans to women in India that can buy a sewing machine or whatever. Muhammad Yunus get a Nobel Prize for this idea that you say those people who have the capacity to earn money, but they just need a small amount of money just to start up, to buy a sewing machine and to buy some piece of cloth that they can sew. So these are just forms of indirect finance, because what happens? The people with a surplus of money don't know, for instance, the people who have a shortage. And how does the bank function in this scheme? They are, let's say, the central point. They bring shortage and supply and surplus together. For instance, in this form of microcredit, but also in the form of you and your mortgage. You don't know that, for instance, the old guy who lives next to you has, let's say, 100,000 euros to spare while you are in desperate need for it. The bank is the central point. So it's, let's say, a coordination problem. Okay, mortgages and debts, yes, they usually go by the intermediaries, usually banks. And why is this important? For instance, one thing that is important with banks is they can monitor the loan. While if you do a direct loan to, for instance, a friend, you have to monitor yourself, and all those, let's say, agency costs can be problematic. Another thing is direct finance. So indirect is via banks, direct is via markets. So the direct way for money transfers from the shortage to the surplus is via markets. And those can be equity or stock markets. And then you are partly owner of a company. You cough up some money. You get a certificate that you're partly owner. And this is a way of financing. There is no intermediary there. There is a direct relation via the markets. And bonds, let's say, bonds are those pieces of debt that should be just loans. Bonds are pieces of debt, just like a loan. The only thing that is different from a loan, that is, loans aren't tradable. So you cannot trade a loan. If you have a loan, for instance, with ABN AMRO, Citibank, or which other bank, they cannot sell it directly, or you cannot buy it. That you walk in, let's say, to Citibank, and you say, okay, I heard my neighbor had a loan here, give it to me, I want to buy it from you. This is impossible, while bonds are pieces of tradable debt. So they are tradable. So the only difference with a loan and a bond is that bonds are usually cover a very large amount of money, and that bonds are tradable while normal loans aren't tradable. So this is a distinct difference. Usually you only issue bonds if you need a very large amount of money. So let's say for small companies and private individuals, issuing bonds is not an issue. It is too large. But we talked about, for instance, Shell and wanted to exploit an oil field in Nigeria. They need 400 billion. They go to ABN AMRO. I want a loan. ABN AMRO says 400 billion. I don't have it on the shelf, my friend. What you should do is cut it up into small pieces, let's say of 1,000 euros each, and sell it publicly so that private individuals and companies can buy pieces of this loan. Yes? So this is what a bond does. And if you look at the bond,